multiple choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hello, everyone. I'm Zach from Earmark. Thanks for joining us today or watching this on demand. Welcome to Navigate Private Equity and Accounting, Direct Benefits for Professionals. I'm going to hand this over to your instructor for today now, Steve Shine. Steve is the co-founder of the Franklin Alliance. Steve, please take it away.
Awesome. Thank you, Zach. Here's a quick slide on who we are. I won't bore you with the details. I'm an entrepreneur and a venture capitalist. Our team here at the Franklin Alliance has experience in private equity, venture capital, entrepreneurship, operations, and search funds. And effectively, we have the experience to talk about this topic, but we intentionally built the Franklin Alliance to pick kind of the best flavors and discard some of the parts that we felt were worse for small businesses. And we'll kind of outline all of that throughout this presentation. So why are we all here today talking about private equity? Well, as you can see here, there's been a plethora of deals that have occurred in the space. And I'm sure some of you recognize some names here on the screen: Citron Cooperman, Grant Thornton, Baker Tilly, to name a few. In aggregate, private equity has poured over $50 billion of new capital into the CPA industry since 2020, which is obviously a massive amount of money. More change has taken place in the last 5 years in the accounting industry than in the previous 135 years combined. I can't take credit for that quote. One of our strategic advisors, Alan Quoten, gets the attribution for that. Overall, private equity money, the succession squeeze that's going on, the hiring bottlenecks that we've all heard about, right? The statistics: for every 7 accountants exiting the industry, there's only 1 coming in, et cetera. The technological pace of change that's occurring in the industry. They're all very dynamic pieces that kind of come together to create an interesting time. As they say, the old saying, right? May you live in interesting times. It's certainly an interesting time in the accounting industry, and we think it's filled with opportunity. And so we're excited to outline how this opportunity can benefit professionals in the space. We're going to start off by covering why private equity likes accounting. Then we'll transition to the alternatives to private equity and key variables to consider. A quick primer: the slides here are intended to be materially dense, so accounting firm owners can refer back to them, and they have a wide range of information to leverage tactically. I'll cover everything that requires a deep dive, and others will just kind of touch on at a cursory level, but please feel free to request the slides if you want to reference anything subsequently, or if you have any questions during the presentation, please just hop in. We can keep it conversational. Here's an overview on why private equity likes accounting. These are the key variables. We'll go through them each in detail subsequently, but at a high level, it's a highly fragmented industry. It's a large market. It has stable growth, and it's recession resilient. There are tailwinds for consolidation. There's an attractive kind of business playbook to implement at the firms. And then there's a valuation arbitrage that is represented in the market. So let's go through these one by one. The first one: it's a highly fragmented industry, which basically just means that there's a lot of firms, which represent a lot of targets for a private equity firm to buy. As you can see on the slide, as of 2022, there was just under 90,000 firms in the US. This is accounting generally. So not necessarily all CPA firms, et cetera. But you can also see that the largest firms represent only, on the right of the slide here, my right, you can see that the largest firms represent about 20%, and the remaining 80% is representative of the kind of entire long tail of firms in the industry. So there's a lot of targets to acquire in this segment. And later we'll see that there's also a valuation benefit to firms, to private equity firms acquiring firms in this segment. So here we touch on the second point, which is that it's a large, growing, resilient market. PE investors like stability and growth. Accounting is a must-have service. It's not a nice-to-have, right? As you can see on the slide, the famous Ben Franklin quote. Well, Ben Franklin gets credit for the quote, but not sure who first originally said it. Nothing is certain in life except for death and taxes, right? We all need an accountant. That, by the way, is why our platform is called the Franklin Alliance. Pay homage to that quote. But effectively, this is a need-to-have service, and it's growing year over year. It's a massive market. TAM on the slide just means total addressable market. You can see that the numbers are pretty massive. The industry's been growing at a stable pace historically, and it's forecasted to continue to grow at that stable pace, if not even a little bit higher going forward. There's tailwinds for a consolidator. So namely, right, as we talk about a succession squeeze, here you can see some data that 57% of firms polled in this survey highlighted that they would need succession in the next 5 years in aggregate. There's a lot of need for succession, and that creates an opportunity for private equity to step in and consolidate firms and consolidate resources, and kind of be a backstop for those firms that need to find a home for their clients and for their employees. There's an attractive business proposition, which is predicated on some key tenets like cross-selling, broadening services, investments into recruiting, technology, and offshoring. Namely, accountants are a trusted advisor to their clients. So it's a straightforward process to expand the scope when you have trust, client trust. Let me explain this a bit. Valuation arbitrage is driven by the fact that small firms, when we say small, I mean low to mid single-digit millions of revenue. So those firms typically trade at, let's say, 2 to 4 times cash flow. EBITDA on the slide is just a proxy for cash flow. So, per the data, those firms trade at, 2 to 4 times cash flow, or 0.8 to 1.2 times revenue. Larger firms, $20 million of revenue and upward, they trade for multiples that are upwards of 3 times higher than the multiples that I just highlighted earlier for smaller firms. So for the same $1 of cash flow that your firm generates, you're given upwards of 3 times more from a buyer if you're in this larger firm bucket. And that's because the market views larger firms as less risky, the more diversified client base, et cetera. So the valuation arbitrage plays effectively to buy low and sell high in terms of multiples. So if you can buy in the smaller segment where the multiples are lower and consolidate and create efficiencies, create a larger firm of scale, you can sell for the larger multiple, which creates economic advantage for everyone who has equity in the entity. So now we'll transition to double clicking on the ecosystem of private equity, as well as the alternatives for private equity, and what the key variables to consider are for firm owners or for professionals in the space. So this is one of the most important slides. I recognize that there's a lot of text here on the slide. Don't worry about kind of consuming all of it later. Again, the purpose of the information throughput here is just so people can refer back to it. But we'll go through a voiceover and step through all of the key points of this slide now. The columns that you'll see represent the types of acquirers or investment partners for accounting firms. So that starts off with a traditional partner structure, which is a larger CPA firm acquiring a smaller firm. The next one is private equity. The third is individual CPA acquirers. And the fourth is the alliance model, something like the Franklin Alliance. So we'll step through kind of each of them. And what we try to highlight for each of these variables is the important kind of framework to consider as it relates to the inputs, deal inputs, right? Regarding valuation, the deal dynamics, capital, potential upside, culture, control provisions, and brand. So we'll start off with the first one, the traditional partner structure. This is a larger firm, larger regional firm acquiring a smaller firm. Normally, in these types of transactions, the larger firm can afford to pay a fair valuation. In some cases, they can even remove some redundant costs and benefit from some synergies because they, have the infrastructure in place as a larger firm, right? So because of that, they offset some costs. They can afford to pay a fair valuation. But as an offset to that, deal dynamics here are very limited. You're normally not given the opportunity to roll like significant equity post-transaction. And when I say roll equity, what I mean is you're not allowed to own a significant piece of equity in the entity post the transaction, because the larger firm obviously has its own kind of stakeholders and processes that need to be addressed. So things like upside, equity upside post the transaction, capital for growth, things like that are normally pretty limited. And also control is very limited. In these types of transactions, the larger firm typically it forces the smaller firm to subscribe to all of the key processes, the technology, the work from home policies, the entire kind of HR stack, et cetera. And it needs to be done within a pretty swift amount of time post-transaction. So these types of deals are good for a firm that wants to be acquired, that cares a lot about valuation, but doesn't care as much about retaining upside, operational control, or maintaining kind of a company legacy or processes, right? In most cases, the smaller firm is subsumed fully by the larger firm. The name of the firm goes away. The brand, becomes part of the larger firm, and the culture becomes a part of the larger firm, for better or for worse. The next the next column here is private equity. Private equity firms typically invest in businesses that are between, low double-digit millions of revenue and higher, and significantly higher. So for an accounting firm that's, a $5 million revenue firm, or really anything less than 10 million, they may be subscale for a traditional private equity firm, which means they'll view it as more risk, and they won't necessarily view it as a standalone entity or be willing to pay a fair valuation for it. Or I guess said another way, they won't be willing to press towards the top end of the range of valuation because of those dynamics. Having said that, there are some kind of flexibility. There is some flexibility as it relates to the deal dynamics. You are provisioned as part of these transactions to own equity post-transaction, which is great because that equity can, as part of the private equity transaction, can be worth a lot over time, and I'll explain why. They also do provide capital for growth, and that could mean doing acquisitions under your firm. That could mean kind of recruiting ahead of demand, et cetera. So owners do benefit and enjoy that potential upside post-transaction. Control is an interesting one here because many CEOs of private equity-backed entities report that they feel more like an employee kind of reporting to the private equity board than an owner with autonomy. I think that is very much dependent on the type of partner you find, but it's definitely prevalent in the space, so something to be aware of. Culture is another one that's important. I think it's heavily predicated on the type of partner that you have, but I think there's a narrative and a certain predisposition that the industry has and feels towards private equity. And that can affect the brand, the brand perception for clients or for employees. So private equity is good for a firm that has, let's say, mid double-digit millions of revenue, right? Let's say 15 million of revenue or higher, whose leadership cares about valuation and wants to maintain equity in the entity and cares about the equity upside post-transaction, but doesn't care as much about the operational control and autonomy. Moving on to the third one, individual CPA acquirers. This one's pretty straightforward. It's effectively a small firm is looking, the leadership of a small firm is looking to retire, finds an individual CPA that wants to go off on their own, buy the small firm either with their own cash or they take out a loan because they don't have a massive balance sheet. They don't have the balance sheet of a private equity firm or a regional CPA firm or an alliance. They can't afford to pay the highest price. They can't afford to put equity necessarily into the business to do acquisitions, et cetera. There's a limited amount of control because naturally the buyer is taking over the firm, and so the seller is no longer in control of the entity, of the legacy, the brand, et cetera. This is good for a small firm owner who's really not trying to get the most out of the economics, but is looking to retire and thinks they found someone that can service their clients. Lastly, we'll talk about the alliance model. So we and other alliances in general, but specifically the Franklin Alliance, is not a fund. It's not a private equity fund. It's a company, an accounting company, with patient capital partners that allows us to make long-term decisions that are best for our firms rather than kind of short-term decisions that are forced for short-term gain because there's a need to flip an entity in a certain amount of years to pay back investors, right? That's what we've intentionally built this to avoid. So we have capital from venture capitalists, from high net worth individuals, people that maintain a longer term perspective and want to build something here that's best suited for small business. So because of that, and because we have our investment sources, we can pay fair valuations, but we can also offer the deal dynamics that we highlighted earlier, meaning you can own equity in the business post transaction. You can take advantage of the additional capital given for growth and the potential upside that drives, and most importantly, control. You maintain operational autonomy here, which is, I think, which addresses kind of one of the key concerns that firms typically have with private equity. And culture and brand are I think something that we here value very highly. I mean, just a quick kind of anecdote. Two of the firms that the first two firms that we actually partnered with, the Franklin Alliance, they're second generation CPA firms. The principals of both firms are running the firms that their fathers respectively both started years ago. And so, their last name is on the door. They care a lot about legacy and identity and culture. And they chose to pick us. And for those reasons, we're proud of the fact that we try to differentiate ourselves based on culture. But effectively, the alliance model is good for a single digit millions revenue firm that wants a fair valuation, but also cares a lot about culture, wants to maintain the culture, the legacy, and the operational autonomy of the business while retaining upside economics in the firm. So this slide's all about what are the resources that the private equity firm is offering you. It's important to be aware that any investment partner should be offering things like recruiting, assistance, technology, organic revenue growth levers, acquisitions, succession planning, data management. I would say an important thing to ask any institutional capital partner is, have they helped firms in similar size to your firm? And ask to talk to those firm owners directly. Have they maintained the culture? Have they preserved the legacy of the firm? Have they maintained the internal operations that the owners wanted to maintain? Can they keep the tech stack that's currently working? Will the working policies be maintained? Will you have operational control? An example of that is, will you be forced to get rid of all the clients that are paying less than, a regional firm's $5,000 a year minimum for tax compliance, right? This is just a high level outline of how these transactions take place. There are some legal restrictions around non-CPAs owning CPA firms. And because of that, this construct was created, which is effectively you create a new entity and then you have a services agreement between the attest firm and the new entity. It's called the alternative practice structure. This just highlights the levers of how an alliance partner can help you maximize the value of your firm. It's effectively about feeling confident that you have the resources around you to allow you to feel comfortable taking on more work and that it won't all fall on you as a leadership team. Strategic partners can help you work on the business rather than in the weeds of the business. And then also you benefit from the resources and the scale of a larger valuation multiple as part of a larger entity. This is, again, a rather important slide. There's a lot going on here, but I'll give you the voiceover. Essentially, we're comparing succession for someone interested in retiring in, let's say, the next 5 years, right? The left represents the status quo for a hypothetical $3 million revenue firm, right? That the owner wants to stay involved for the next 5 years. In, let's say, year 3 or 4 from now, they decide that they want to retire. They find a buyer, but the buyer has agita, and they're concerned that the customers of the firm are going to leave when you, the seller, decide to leave, because all of them have a relationship with you as a seller and they've known you forever and they trust you. And so when you leave, the buyer doesn't know if the customers are going to stay. So what they do, the buyer that is they pay a certain amount of capital up front, which you'll see here, right? In year 5, when they want to buy the firm, they'll put a minority percentage down, and then they'll want to pay you as the seller over time based on what they collect from your clients. But the problem with that is, one, you have to wait for years, in the worst case, 5 to 10 years additional from that point in time. And in addition, you're also betting that they're going to take good care of the clients, because if they don't, and they don't collect from those clients, then that affects how much money you as the seller get, right? So there's all this uncertainty in this time that is outside of your control in this hypothetical scenario. And we see this taking place all the time in the market. The right side, right, option 2 under the Franklin Alliance is, as you'll see, you maintain the salary, right? You also get cash up front now for the portion of the business that you sell. But in addition to that, you collect deferred payments annually while you're in control of the client management aspects of the business. So here, overall, your net cash flow each year is higher because you're actually extracting a piece of value of the firm annually while you're in control of the business. And then in year 5, your equity can be sold, and it would be valued at a much higher multiple because it's part of a larger entity. It goes back to our previous slide talking about valuation arbitrage. The larger entity, being a part of the larger entity, means that your equity in the firm is worth a higher multiple. So at that time, right, you're able to sell that equity and receive much more. And also you'll receive it faster because you won't need to wait for a buyer to say, oh, I've collected from the clients, right? At that point, an alliance will already be comfortable because they've been operating with you as the owner for years. So overall, in this hypothetical example, the owner or ownership gets an extra $2 million here for a hypothetical $3 million revenue firm, right? And so you can, and as I'm sure you can estimate here, the delta there in dollar amount in dollar value goes way up as the firm size increase. So the moral of the story here is that there are options, and being proactive really helps extract the most value from the firm and keeps the clients happy, and make sure that there's a great home for the clients and the employees of the firm. this is an outline of who the strategic advisors are for the alliance. The reason we highlight this is because it's important to know who are the people around the table that are there to help you and your firm. The way that we construct a strategic alliance, a strategic advisory board to help our alliance member firms, is we want to have someone who has experience growing a firm from 0 to $5 million of revenue, from $5 million of revenue to 15, from 15 to 50. And then, even people that have experience managing firms much larger than that, like Rick Dreyer, for example, who's on our strategic advisory board, who was the previous CEO and chairman of the board of Wifley, which is, a massive firm in the US. So effectively, the goal here is just creating an infrastructure of knowledge sharing so people don't need to reinvent the wheel for everything that they're trying to do, whether that's technology, whether that's offshoring, whether that's marketing, recruiting, whatever it is. Like, most likely there's a firm who has faced something similar. And so we try to create a crucible where people can learn from each other, and from people that have experience in navigating some similar challenges. And we think that's kind of an important thing to lean on and ask and be pretty pointed about with any potential investment partner that you consider, as it relates to how they will help your firm.
Hey, Steve, I just wanted to tell you, you had a couple questions come in.
Oh, cool.
So Brian, I can read this to you. Brian asked, how much does a firm's use of technology impact its valuation? Is it any factor?
Yeah, good question, Brian. Yes, it affects it in multiple ways. So, as I highlighted earlier, a buyer of a firm is concerned at times that the relationships that are held with leadership, right, what will happen to those relationships when leadership transitions, right? A buyer is concerned about that naturally. But if there are very strong technological processes in place, then the buyer isn't investing in only the leadership's relationships with their clients. They're also investing in the asset of the technological processes that have put in place, which makes it easier to transition work, right? Which creates value outside in addition to the relationships that the owner has with, the client base. So a direct example is, if a firm is more scalable because it has great processes and, there's a lot of work that the firm is turning away regularly, and, they have the processes, but they don't have the human capital to service that work, right? They need to recruit people. If that firm has great technological processes and they can see where there's capacity constraints in the business, right? They know how they can address those constraints, and they can build confidence that that firm can grow without breaking things. So naturally, a buyer will be able to justify paying more and a higher valuation for that firm that has better processes, because one, they can bet on growth. Two, they're more confident that there's an asset there as it relates to the infrastructure of the business rather than just the relationships of the owners. And it also just is a signal that the firm is embracing the change that's occurring in the industry. And at the end of the day, a partnership is about working well together as a team, right? And so if people don't want to embrace change and embrace the fast pace of technology proliferation, then a buyer might not want to pay a higher multiple because they think that they're not going to be able to stay on the cutting edge of the way technology is moving, because maybe they feel like the seller is old school and won't embrace it, or has a closed mindset. So I think it very much impacts the valuation, and it impacts the prospects of the firm. I'll move on to the next one. Are you looking for companies in Brazil? We appreciate it. Thank you for the question. No, we are US based. So Brazil is beautiful, but unfortunately it's outside of the scope for us. Next question here, Howard. Going off of Brian's question, any other factors or considerations that might make a PE firm alliance worth more or less? I guess, Howard, are you referring to considerations that make like a target firm being acquired worth more or less? Or are you asking about like the valuation of an alliance specifically, like what, like the valuation that a larger entity? Oh, you're asking about the alliance specifically. I'll take both. Effectively, size and efficiency are important as it relates to how private equity values businesses, right? Higher margin firms will, all things equal, will get the same. A higher margin firm, if they get the same valuation multiple, will be worth more because you're multiplying times a higher, cash flow naturally, right? So profitability and scale will impact the valuation a firm will pay. Our business model as an alliance is to partner with firms that are smaller than the target private equity firm typically looks to partner with, right? So we're looking at firms that with single digit millions of revenue up to kind of low double digit millions, because that is the segment where there are a massive amount of firms in the US that we feel like we can benefit operationally. And those firms trade for low single digit multiples of cash flow, right? But if you put them together in an alliance where they still maintain operational autonomy, but they get the benefit from the multiple of a larger entity, right? Now, instead of getting a low single digit multiple, they can get double or even triple that. So their equity that they own in their firm, right, just by being a part of a larger entity becomes worth double or triple what it would have been as a standalone entity. And the things that affect that are, right, stability, resource sharing, economies of scale, the cost benefits that we can pass to our firms, just by having relationships at the platform level that benefit from economies of scale. So hopefully that answers your question. If there's any other questions, please feel free. That's the last slide that I have for everyone. If anyone has questions, please feel free to reach out to me directly. There's my email on the slide. It's steve@franklinalliance.co. People can hit us up on LinkedIn, email. You can check out our website. There it is, franklinalliance.co. We're trying to be very, transparent here, open kimono. We think that this knowledge is important for people in the industry to be aware of, especially as the industry is, changing rapidly. And even if, you're not interested in us, but we can provide some, free resources for you guys. We want to pay that forward as well. So check us out. You can check out what we offer for free on the website. And we're, more than happy to help in any way we can. Do you have any? I'll answer a couple questions here, Zach, if I can, if we have time.
Yeah, go ahead.
One more thing, if time permits. I've heard a lot of horror stories about PE, things like them changing the culture, forcing change, firing clients and people. What is your perspective on this? Is there any truth to it? Yeah, it's a good question, Howard. Yes, we've heard a lot of similar horror stories. And whether that's a PE firm or a regional accounting firm that's backed by PE buying a smaller firm, we've certainly heard of numerous stories of there's a culture imbalance, you're forcing change, you're firing clients, you're firing people, changing culture, right? Part of the reason that we wanted to launch this is because we think there's an opportunity to offer a better fit for smaller firms, right? Smaller firms don't have the infrastructure of a $20 million revenue firm. For a $20, $30, $40 million revenue firm, maybe the infrastructure is already in place where the firm will feel less change when they partner with private equity, right? And so in that case, maybe the firm is already implementing a $5,000 minimum for tax clients. Maybe they're already forcing change as it relates to technology or utilization tracking or KPIs or work from home policies, right? There's more infrastructure around that firm when it reaches that scale. So partnering with a private equity firm doesn't feel as abrupt. It doesn't feel like as much of a stark change. And thus, there's less cultural imbalance. But with smaller firms, those smaller firms don't necessarily have that same infrastructure, right? So when they partner with a private equity firm, it's like a pretty drastic change, and people feel that impact. And it's not always received well. So to your comment, yes, there is certainly truth to that. I think painting with a broad brush is dangerous. There are certainly some great private equity firms out there, but I think it's important to understand how much capital do they need to invest, right? Like, how big is the fund? If they're buying, if they have billions of dollars to invest and they're buying $5 million revenue firms, how are they, like, the math just doesn't work, right? So they're going to need to buy bigger firms, and then your firm is going to, as a $8 to $10 million firm or less, you're going to be a drop in the bucket as it relates to their larger portfolio. So all of these nuances are important things to consider. And yes, there's certainly some truth to it. I think it's really just important to get to know the people and the strategy of the institutional firm that you're looking to partner with. And those are all the reasons why we launched this, is because we wanted to create something different that did kind of value culture and the autonomy and the things that make a small firm great. Because there's a lot of clients out there that prefer to work with a small firm because they feel like they get the one-to-one treatment of local people serving other local people, right? So yeah, good question. I'm glad you asked it. Thanks. Another question. Do you have any issues with retention when PE or alliances come in? Do you have any suggestion or tips to help with that? Yeah, I think there's a couple different kind of ways you can take that. If it's a PE-backed regional firm that's acquiring a small firm, sometimes clients might think that your firm has more resources now, right? So maybe they're more comfortable, just to kind of steel man the other side of that argument, right? Maybe they think you have more resources and they're more comfortable with it. On the other side, maybe they get less personal treatment. The customer service goes down the drain, and they feel like they're no longer cared about, right? Because PE came in and they care about larger clients. So yes, that's certainly something to be aware of. I think we try very hard as an alliance to not let that happen, because we focus exclusively on firms in the smaller segment of the market, right? So, single digit millions of revenue up to lower double digit millions of revenue, that strike zone is where, we try to help. And so we don't, we're not forsaking those clients, right? Those local people, because that's that's the target market of who we're trying to serve. So for us, we haven't seen any retention issues as it relates to clients or firms that have joined the alliance. I think if the alliance values small business and local people and community, I don't think you would see retention issues. I think if the private equity firm cares about, growing to hundreds of millions of revenue as a platform very quickly, and you're a small firm, then yes, I think there will be retention issues, because it'll be very clear what the goal of the private equity firm is, or the large regional firm that's backed by private equity. And so, you'll see it coming. I think it's important to talk to firm owners who have partnered with that alliance or with that private equity firm, and they should tell you straight up how this is, what their experiences were, right? And hopefully that'll be an unbiased perspective. All right, I think overall general question from Brian, where do you see the future of private equity and accounting going? Will most mid-sized firms be PE owned and combined into larger entities? Yeah, that's a good question, Brian. And surely there's a big portion of that. I don't mean to be self-serving at all with this answer, but I have to share that part of the reason why we think alliances should be more prolific in the space is because we think small firms should be able to operate with autonomy, with the resources of a large firm, while still serving local people and local businesses. So if that can take place with an alliance model, then there could be alliance models with hundreds of firms that are local firms with autonomy, second generation, third generation firms, et cetera, that care about legacy and care about identity, right? And they're running with the resources of an alliance so they can compete with larger firms, right? And if that happens, we think that those firms could operate and have great balance, right? Have more professional and personal balance, right? Leverage more resources of the collective, leverage the knowledge sharing of a collective. And that could be something that exists in this lower kind of segment of the market. I think as it relates to the larger segment, we're already seeing that there's massive consolidation occurring. The top, I think the math is that like if you're over 6.5 million or something around that range, you're a top 500 firm, I believe, in the US. So among those firms in revenue, like I wouldn't be surprised if a majority of them have talked to private equity. There are statistics out there. I can't quote them offhand in terms of what percentage of those firms are already private equity backed, but it's pretty significant. And we know that those private equity backed large firms, they have a lot of capital to go swallow up a massive amount of small firms. So so the answer to your question is yes, consolidation is occurring at a more rapid pace than we've ever seen. And so I think that it begs the question, like, how should small firms compete? And what lane is created for small firms that allows them to continue to kind of grow and prosper, but not be subsumed and kind of lose their culture and lose their autonomy and their kind of, their legacy and the name of their firm, right? So good question. I think it's for firms that embrace the change, I think it's a very positive time to be in the accounting industry. Technology is moving extremely fast. We've seen the benefits of it firsthand. We have relationships with all of the kind of the biggest technology providers in the space just because of, my background and our collective backgrounds. We spent a lot of time and we've seen demos and we've seen use cases, and it's exciting. I mean, over time, accounting professionals we believe will be able to spend more time nurturing relationships with their clients and less time with manual kind of processes and the minutia that comes with manual processes, right? Technology should be able to really buttress a lot of those workflows. And we think that will result in efficiency and people spending more time doing what they like, which for a lot of people is, serving their clients well. So I think it's an exciting time to be in the industry, especially for people that are willing to embrace the change. All right. I think, Zach, I don't see any other questions here.
Yeah, great. That was great. Thank you so much, Steve. And thanks for everyone who attended and watched this live. If you are here live, here's a quick reminder on how you can earn CPE for attending today's webinar.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.